Good afternoon. Welcome to the TheoTrade Afternoon video. I am Blake Young. Today is October 3rd, 2024, and we're going to discuss it's about what you need. And we'll start with the ES, the S&P futures, the fact that we've tried to push through this low 57.55 and get into a little bit of a sell-off, possibly targeting this 5,700 mark. And we've failed to do so the last 3 days in a row, no matter whether or not the Fed chair has said that we will not be cutting rates in the future, which started this sell-off here, but there's no follow through. So the question is, if they're not going to cut rates, and we know that money is not going to be as easily flowing as we had anticipated, are we going to see more restrictive policy continue for longer? Now, again, more restrictive certainly is less because we had the 50 basis point cut, but if we're not going to see those types of cuts again before the end of the year, this sell-off could do what we did back here in August. We could see it kind of chatter sideways and then slam down. We could chatter sideways here and slam down. We could easily see 5,600 on the table. But the ES is not necessarily the best representation of how the economy is doing and what we should be looking at. We should be looking at if rates are going to stay where they're at, and if money is restrictive and inflation is high, then we should be going back to those core things that we need, the core things that we have to spend money on. In fact, if we look at today and we look at the recovery and the rally in the S&P and the NASDAQ and the recovery off of these lows, we could look at the charts and see it was really driven almost exclusively by energy and NVIDIA. That's it. Everything else is red, 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 red. And so when I look at this, energy prices are going up. NVIDIA is the only thing that's really holding up the market compared to everything else. Everything is red, and we're being lifted by a single stock. So if that's the case, we are likely to see money stay into or go into consumer staples, healthcare, and utilities. And energy prices are going to eat up some of the expendable income as well as far as energy goes. So let's go take a look at crude. And we'll get into the discussion of consumer staples in just a minute. But let's start with crude and go look at the crude prices. And we'll look at the crude contracts that are going to be expiring in November. That's our front month contract anyway. And you can see we've created a very distinct higher high, higher low as of today. We've got close prices making higher lows, higher highs, which means I expect us to get back up to 76, maybe 77, and even potentially all the way back up to 82 as we're creating higher lows through here. Remember that even though we put more money out into the market with the Fed, even though the U.S. government released some of the strategic petrol reserves to lower prices off $100. They've now rebuilt, they bought a ton of oil to put back in the reserves, which increased that demand, and that's really kind of here. That's that candle. We increased the demand from the U.S. buying up huge amounts of oil, millions of barrels, and pushing those prices higher. And again, we have further conflict in the Middle East, and so this is, like I said, easy target 77, likely up to 81, 82 in a very short order period of time. And this is the entire year chart. If we look at crude back through the year, we're talking about a return back to the previous highs. Now, that will impact retail gas prices, which means you and I. Now, if you look at this chart, the retail gas prices, and you see we've created this similar higher low, higher high breakout. If we're breaking out at 203 and we're just looking at this move, we would expect another 15-20 cents above there, which would put us up to right here about 216. I believe we're going to go to 230, very likely to 240, and possibly to 260. Keep in mind that 260 on the retail gas futures, for most people, you're going to see an increase of about $1 more than the current prices, which means we're back to $4.25 to $5 across the country. And that $4 to $5 cost for fuel is going to, again, pinch the consumer. It's going to squeeze them even further as we see prices continue to push up to those highs. So these are really where the places I want to be looking for trade opportunities. I want to be looking at the idea of buying into the energy sector. And if I know that we're going to be using our expendable income in here, I want to be looking for short positions in consumer discretionary. We've already seen Nike fail. But at this point, I would be looking for long positions in the energy companies, specifically the oil and exploration companies. We've talked before about FANG and EOG, and I do like the setup here. Even though it didn't clear the high, it did close past the close. I would argue this is a double bottom on FANG, and we've got a 169 to 185. We should be able to see another $16 move above this 185 level, which would take us up to just past 200. And sizable move, looking for about an 8 to 10% move up in FANG. Adding to that, we can actually look at Diamondback and then go to Valero. So Valero is not one that I'd put in the same category here, but we will go look at Valero. Valero has had some really rough pushes through here, but look at the size of that recovery. Look at the breakout. I don't know if we're going to see just this little tiny move. Otherwise, we're already there. So I'm looking at this, that if we can clear 147, we're going to be moving about 10% higher than 147 as well. And that's going to push us up to 161, push us up into these previous highs. In addition to Valero and FANG, or Diamondback Energy, Marathon, MPC, also cleared their consolidation like Valero. And if we get through the next high like Valero, then I'm looking for a $17 to $18 move, which is an additional 10% above this high. So if we get through 177, I'm expecting another 10% climb in MPC, and that's going to bring you all the way up here to about 195 to 200 as well. Now, energy prices and energy stocks are certainly going bullish and had a lot of volume behind it, and we're seeing that push higher, and I don't see the end of that in the foreseeable future. But as we're looking at that, one of the other things I'd be paying attention to is whether we're going to see money move back into consumer staples, back into healthcare, back into utilities, despite the fact that they've had a little bit of a pullback today. So looking at that consumer staples view, from the big picture, I want to see it establish some sort of bounce. Now, that could be at this gap right here. It's almost perfectly stalled at that gap. But I think we could push one more time lower and go for 80. And if we go for 80, that's where I'll look for a bounce and a return back to 83 or 85. It's not a huge move in XLP, but it should set us up better in some of the other consumer discretionary stocks. Taking Altria as an example, there's a lot of buyers here. Post earnings, we saw a gap down close up, and it reconfirmed and established this support level about $49. So another $1 lower move and any type of stall in the drop, in the descent, I would be interested in buying at 49 on MO and looking for it to get back to 53, if not 54. Now that would give us another 10% recovery off the low, but right now it's a falling knife. We want to see it stop falling. Same thing is true on Procter & Gamble. If we look at Procter & Gamble, we're trying to plan ahead that if we see oil prices continue going higher, we know that the excess money will likely be pushed to these consumer staples, and this pullback is just going to give us a better opportunity for cheaper pricing. Now, Procter & Gamble, we have its earnings, the gap down, close up. I do like this support area and this barrier where there's a lot of buying and selling that's gone on before about 166. If we drop to 166 and stabilize, I don't even need to go back to the previous high. We go to 176, and we're looking for about an 8% recovery in Procter & Gamble. But, as you know, one of my favorites is Costco. So if we go to Costco, Costco is already trying to stabilize right here at the near-term lows. This is the previous resistance. It's a gap area. It's a support area. It's been the same support area all the way back through August. And as we're looking at this, they had an amazing earnings and making $5.29 a share, higher than anticipated. And yet we gapped down. So some guidance on that downward side. But one of the things I have seen as I've gone locally to the different Costcos is very busy parking lots. And I know this is associated with the strikes, that people are now trying to stockpile the things they don't think they're going to be able to get a hold of, that these strikes will last longer. And so there's going to be increased demand at Costco this quarter. And so as we're looking at these barriers, these lows, this is a good place to look at a lower cost entry price on something like Costco. And if we can see this stabilize near these lows, something to be aware of is that Costco not only is at a key level and outperformed earnings and has had a very strong earnings season the last year, we're looking at about a 2.5 to 3% return on a short put or a naked put, and have an opportunity to buy that there for a month to get about 2.5 to 3%. Or if we can bounce here and return back to the near-term highs, that's about 5 to 8%. So I like the idea of a short put here, not necessarily trying to get a sign, but having a short put give us about 2.5% return, knowing that I don't have to get the bounce. I just have to not have it go any lower to capture that same 2.5%. If you're wanting something that looks bearish, and even though I do believe we'll see stability in healthcare. I'm still leaning against or away from biotechs. Now the price pattern looks somewhat similar, but we've created an equal high, equal high, equal high, equal low, and we're trying to push through this low today. And so this is not quite just a retest of the last support. This is the third or fourth attempt, depending on how you want to look at this right through here, at reversing this entire pattern. Now that 150 down to 142, we're looking for about an 8-point move. That's a 5% drop, and you'd be looking for it to drop somewhere down into this area through here, which means we'd be going to 134, 136 on IBB. Now that would also be available for same things like Abbott Labs. You would look for Abbott Labs being a short position if it can break through this support, and the shadow did, and it actually closed lower than the last low. If that can fall back to its next support level, we're going from 112 to 107 to 106, somewhere in here, and we'd be looking at about a 4% drop in Abbott Labs. Medtronic also feels very heavy with the size of today's sell-off and the fact that it's the lowest close that Medtronic has had going all the way back to its earnings. That this pattern is a lower high and lower low, arguably. And you'll be able to see that a little bit better if you get rid of these lower shadows and kind of focus more on the line or the close price. As you can see, this is lower highs, lower lows, and we absolutely close down at the lowest price here. If that is strong enough breakout, we could be looking from 91 down to about 88. Doesn't look like much, but we'd say a $3 move would bring us down to about 85. That puts us well on track to see a erasure of this big bullish move, and at least half of it if we're not going to go for the full thing. But all in all, I'm still in the mood for defensive stocks. I'm still looking at the stuff that we need and buying the stuff that we constantly need, meaning the companies that produce what we need. The stuff we do not need, I'm going to avoid, and I'm going to be looking at continuing with those consumer staples, utilities, and healthcare, but adding energy into the mix as energy prices are rising and will continue to squeeze the consumer. Well, that's going to do it for me. Come join us again tomorrow as we talk about China, inflation, the US dollar, volatility, and so much more. So join Brandon and I in the morning, and we'll see you then.